Good morning, everybody. Welcome back to Morning Markets on the 11th of May. I hope you all had an enjoyable long weekend. A couple of things from the end of last week that we reflected on this morning in our morning meeting. The first of which was the continued strong performance of equity markets, both on Thursday and Friday, taking this to a positive performance for the week. I think the key thing that we were looking at and discussing this morning was just around the performance of the nasdaq, so the more technology or growth orientated equity index in the US. And what did we observe there? Well, surprisingly, it's actually up now year to date, so it's up about 1.7% year to date. It's about 6 to 7% off its all-time high, which was reached in the middle of February. I think even more startling and more stark is the performance from the 23rd of March when the nasdaq has rebounded 33%. So that gives you some indication of the magnitude of the move, but also the type of stocks that have been, I suppose, favoured in this environment, with market participants gravitating towards those that are able to show growth in both revenue, both in earnings, but also that they are capturing the environment or delivering in this more challenging economic environment. I think the other thing that we were looking at and reflecting on was the jobless data that we saw out of the US. Now, as we've been discussing over the past number of weeks, we've seen the claimant count on a weekly basis increase quite materially. So the unemployment rate in the US on Friday came in at 14.7%, or 22 million individuals. That's quite a significant number, but maybe not as bad as some had been expecting. I think the market was suggesting it could have been 16%. But I think it's interesting for two reasons. One, the sheer scale of job losses that we've seen in the US, but also if we just cast our mind back, a couple of months ago, we were talking about a record low unemployment rate in the US at 3.8%. So that gives you just a magnitude of the change that we've seen and the impact that COVID-19 has had on the jobs market. I think the other thing in relation to jobs that is worth touching on, if we look at that report, about 7.7 million of the jobs lost were in the leisure and hospitality sector, and they were deemed to be temporary losses. Now, that, I suppose, gives those that are positive on the outlook a sense of the swiftness of these jobs could return. I think some caution is probably merited, as hospitality and leisure are likely to be the two sectors that open towards the end of the lockdown phase as we gradually reopen economies. So something that will continue to monitor over the coming weeks and months. I think the other thing that we were observing this morning was what's ahead over the coming week. In a relatively, I suppose, quiet week from an economic data standpoint. And we do have data from China, which I think will merit worth looking at, and that's both in relation to fixed asset investment and also output, industrial production later in the week. So those are two things for April that I think we'd be focusing on. I think the other thing just to touch on is that we will see more issuance in the sovereign debt market this week, particularly from the US, and it'll be interesting to observe how the market reacts to that. I suppose ultimately we do have the Fed as a buyer in the secondary market, so it's potentially a moot point as to how the market reacts. But still, in more normal circumstances, this would be something that we would want to see and observe and think about the impact that it has on markets. That's it for today. Please join me again tomorrow. Many thanks.